Closing costs. What are they? Who pays for them? And why do they exist? In this video, we're going to talk about exactly what closing costs are. We're going to dispel a couple different myths, and then I'm going to teach you a couple different ways that you can actually get these paid for or take care of them outside of the traditional sense, which would be the buyer's responsibility to pay their own closing costs. So in a real estate transaction, both the buyer and the seller have their own share of what we consider closing costs. Now, depending on the state that you're in, the dollar amount of these closing costs relative to what you're buying, meaning whenever you're looking at closing costs, there is no blanket statement across the country of how much closing costs are going to be. Every state varies, even every county varies, and then depending on how much you're buying, what the cost of that home is, it's going to be a slightly different percentage from state to state, county to county. But what I can tell you is every state is going to have what we consider closing costs. Now, there's two different things that people get a little bit confused about, and we'll talk about that first. Sometimes people think I have X amount of dollars for down payment, meaning I have saved $50,000. That is what I intend to use for a down payment. And they forget that they either need to include closing costs in that number, which is essentially going to reduce the down payment dollars, or they need to take into consideration that it's going to be $50,000 plus whatever the standard and customary closing costs are for the area that you're buying in. So a lot of people forget to think about that, and they say, I've got $50,000. They tell their real estate professional they have $50,000, and they don't realize, or nobody's really had the conversation and accounted for the closing costs. So make sure you're taking that into consideration. If it's even as simple as doing a quick Google search and saying, how much are closing costs in this county? It'll give you a pretty good estimate. It's not going to be 100% accurate. The internet's purpose is not to be 100% accurate 100% of the time, but it's going to get you a really good ballpark, and you can base it from there. Now, what are closing costs and why do they exist? So whenever you're buying a home, there are a whole bunch of third-party service providers that are going to work on that transaction to make it possible for you to get the keys at the end of your 25 or 30-day escrow or whatever it's set up to be. There's a title company that's going to make sure that the deed of the property is insured and you're the only legal owner. Some states have attorneys that are going to handle the closing paperwork. Some states are what we call escrow states, and there's an escrow company which functions as the unbiased third party that holds all the money in the paperwork until the transaction's complete, and then they get it to where it needs to go. And you pay a fee for those services. You also have fees related to the county recorder's office. The county's going to charge you a fee to record that new deed and to prove on their records that you're the new legal owner of the property. There's a notary who's in charge of making sure the person signing the documents is in fact who they say they are, and they're going to confirm that the person who signed these papers is in fact the person that's supposed to be signing them, and they're going to verify each one of those signatures, and they charge a fee. There's shipping fees. They got to FedEx documents back and forth from one place to the next. They may have to send a courier from that attorney or that title office down to the county to record the deed. They're going to charge a courier fee. It's all the little things that need to take place in order for you to get your home. There's processing fees and doc fees and underwriting. There's a whole bunch of different things that you're going to have to pay for. And those are what I would consider the actual third-party costs in closing costs. There's usually two sides or two halves. It's not a perfect math, but it's about 50-50 in most cases. About half of what you're going to pay in closing costs are going to be third-party service providers. The other half is going to be money that you have to set aside for yourself to be able to make sure that you have money for the first year of homeowners insurance. If you're getting a mortgage, you're going to have to insure that home and make sure that you can replace that home if something was to happen to it. That's going to be a requirement from the mortgage company. You're going to have to set aside a number of months in property taxes to make sure that the property taxes are current. That's important to the person that's making the mortgage to you because property taxes can foreclose. So when you buy the house, they want to make sure you have enough money set aside in this account so that when you go and you have to pay the next installment, or the mortgage company goes to pay that installment on your behalf, there's enough money in that account. So we're talking homeowners insurance for the first year. We're talking sometimes up to 6 months of property taxes that are set aside. And then we have prepaid interest. When you buy a home, mortgage interest is paid in the rears, meaning when you paid the payment on the first of the month, you're paying the interest that was accrued in the previous month. So the 1st through the 31st of the previous month is due on the 1st. And because when you buy a house, you generally are not going to have a payment for the first 30 to 45 days, we need to account for that interest. And that gets lumped into what we call closing costs. That as a total, the third party fees, the money you set aside for taxes and insurance and interest, that total, that pool of money that needs to be brought in is what we call closing costs, and it's a number that you have to account for. So a couple of the ways that this is taken care of, or the way that these get paid, right? How does that work? Because in some situations, it can be quite a bit of money. Let's say you're in the state of California. Right now, the average closing costs are somewhere between 2 and 3%. Let's go on the high end and say it's 3%. If you're buying $1 million house, 2.5% to 3% is $25,000 or $30,000. And if you weren't smart enough, if you weren't prepared to be able to have that money set aside, and that $25,000 or $30,000 isn't something that you have, you could be in a tough spot, right? Let's say you didn't watch this video and you didn't learn about closing costs before you started the process. Your mortgage person wasn't smart enough or wasn't good enough at their job to prepare you for it. And let's say the real estate agent didn't know that you didn't know. Now you're going out and you're looking at homes and you might be $25,000 or $30,000 short to buy that house. So how do we take care of that? Well, one of the ways that we can take care of that is we can ask the seller to pay for those costs. So it's not going to work in every situation, but if we are looking at a property and maybe there's not a lot of activity on that property, or we're in an environment where it's more of a buyer's market, the buyer has more leverage and more room to negotiate, then maybe we can use that leverage to say, hey seller, we want to buy your house, but in order for us to do that, we need you to credit us $25,000 to $30,000 to pay our closing costs. Now, as long as that net, meaning after they give you that credit and it is removed from their proceeds, if they still hit their magic number that makes sense for them to sell their house, they might agree to that. Or maybe it's somewhere in the middle and you guys can find a way to strike a deal and make a balance, and you find a way to cover whatever they're not going to cover and you can still make the deal work. So the first way that we would take care of it, maybe the most opportune way, is to have the seller pay for it. Now, again, not going to work in every circumstance. If it's a really well-priced home and there's a ton of activity and there's 10 other offers, your real estate professional is going to tell you, hey, we can ask for whatever you want to ask for, but it's going to put us at the bottom of the pile and you're probably not going to get the house. That is your decision to make. So take your real estate professional's advice, but in an opportunity, or if there is a situation where there's an opportunity to have the seller pay for it, then we would want to negotiate that and write that into the contract. The other way that it might get covered is through a request for repair. Sometimes you'll get into a house and you'll find that there's a bunch of things that are wrong with the house. Maybe none of them are red flags or they're going to result in the house falling over anytime soon, but it might be several $1,000s worth of repairs that are needed in order for the house to be what you would consider up to par. And you can ask the seller, you can provide a list of the repairs that you feel need to be done to the property, and then you can assign that a dollar value, and you can ask for a credit from the seller in order to offset your closing costs so that you can then free those dollars up to make the repairs, and then you can do whatever it is you want with that money. If you feel the repairs really need to be done, you can get it done. If you feel that you can make a couple of trips to Home Depot and get it done yourself, that is your prerogative. That's your right to do after the close of escrow. Now, the other way, and currently, as you're watching this most likely, the third and the least attractive way would be in the form of a lender credit. And I'm a lender. I'm in this business. I'll tell you right now that nothing is free when somebody is giving you something, right? Even if you're asking from the seller, you're paying for that home, you're buying a home, and they're giving you the credit. If a mortgage company is offering you a lender credit, it's because they're elevating your interest rate in order to create a premium so that they can give that to you in the form of a credit. The problem with that, maybe in the past, if rates were at all-time lows, it wouldn't be a big deal to bump your rate from 2.5% to 3.5% to get a big credit to cover your closing costs. It just doesn't work that way right now. And where rates are, you have to bump the rate so immensely in order to get a credit that makes sense. For a lot of people, it either makes it so that they don't qualify for the home, or the number just gets so ridiculous on paper that it doesn't make any sense. So if you absolutely had to do it and you were completely comfortable with where your payment was, if you were to increase your rate a bit, you may be able to get a small lender credit. It's likely not going to be enough to pay for your closing costs, and the cost benefit of how much that rate has to go up in order for you to get a relatively small credit just doesn't make sense. My 2 cents in most environments, and especially the one that we're talking about right now, which is what we're in, you can see the date on this video, is likely going to be through a seller credit negotiated within the closing cost, or is a seller credit negotiated within the contract up front. So it's agreed upon, the seller is agreeing to pay your closing costs. So that is what closing costs are. Those are the ways that they are traditionally covered. Maybe some outside of the box ways that you can get your closing costs covered. This way you're prepared, you know what to expect, you know how to navigate the system, you know why you're paying them, and then maybe you can do some things, some creative things to make sure that you're not the one writing the check for those. If you have any additional questions, comment on this video. You can always reach out to us in the email in the description below. We'd be happy to help. See you soon.